Listen to me carefully because this is one of those moments when a system changes before most people understand that it has changed. There is an enormous debt sitting on top of the American economy. And whether people like the phrase or not, that debt has become one of the most important forces shaping what happens to savings, investments, wages, taxes, interest rates, and asset prices over the next decade. The number is roughly $39 trillion. Most people hear that number and their minds shut down. It sounds too large to be real, so they treat it like political noise. They hear the national debt mentioned on television. They hear politicians blame one another, and then they go back to doing what they were doing before. That is a mistake. When a debt burden gets this large, it stops being a political talking point and becomes a force of nature inside the financial system. It begins to influence what central banks can do. It influences what governments can afford. It influences what happens to the currency. It influences whether savers get protected or quietly sacrificed. And it influences whether the people who own productive assets become richer, while the people who hold too much cash become poorer without realizing what happened. I have spent my life studying debt cycles, monetary systems, empires, reserve currencies, asset owners, savers, governments, and the recurring patterns that appear when countries borrow more than they can comfortably repay. The pattern is old. The names change. The technology changes. The politicians change. The central bankers change. But the mechanics repeat. When a government has too much debt, it has only a limited number of choices. It can tax more. It can spend less. It can grow faster. It can default directly, or it can reduce the real value of the debt by making money worth less over time. That last method is the one most people do not understand, and it is the one that matters most. Now, it is called financial repression. The name sounds complicated, but the idea is simple. The government and the central bank create a world where interest rates stay below the true rate at which purchasing power is being lost. Savers think they are earning something. They see a number on a bank statement. They see interest being credited to their account. But after inflation, taxes, and currency debasement, they are going backward. The borrower benefits, the lender pays. When the borrower is the government and the lender is the public, the process becomes one of the quietest wealth transfers in the economy. That is why this moment matters. A new Federal Reserve leadership cycle is approaching, and the debate around the next chair is not really about one personality. It is not just about Kevin Warsh or Jerome Powell or any other individual who might sit in that chair. The deeper issue is that the debt cycle has reached a place where the system has fewer and fewer clean choices. The public story will be about rate cuts, inflation, jobs, growth, stability, independence, and technical policy language. The real story is about who pays for a debt burden that cannot be handled honestly through normal methods. Most people will not understand that until after the transfer has already happened. They will think they are being cautious by sitting in cash. They will think they are being responsible by accepting a savings account yield that looks decent on the surface. They will think they are safe because the number of dollars in their account is not falling. But wealth is not measured in dollars. Wealth is measured in what those dollars can buy. That distinction is everything. If you have $100,000 and the cost of living rises faster than the return on that $100,000, you are becoming poorer in real terms, even though the account balance looks stable. That is how financial repression works. It does not usually announce itself with a crash. It works slowly. It works politely. It works through official language. It works through interest rates that look reasonable until you compare them with what is happening to the real purchasing power of money. Most people are trained to fear volatility. They are not trained to fear erosion. Volatility is visible. Erosion is quiet. Volatility makes the market go down on a screen. Erosion lets your account look calm while your future lifestyle disappears 1 year at a time. That is why this subject is so important. The United States is paying roughly $1 trillion a year in interest on its debt. That money is not building roads. It is not improving education. It is not increasing productivity. It is the cost of past decisions. It is the rent on the accumulated debt. Interest expense has become one of the largest line items in the federal budget. It competes with defense. It competes with social programs. It competes with everything else. And unlike discretionary spending, it cannot simply be wished away. It is tied to the debt stock and to the interest rate environment. When the debt is this large, interest rates become political, even when central bankers insist they are technical. If rates stay high, the government has to refinance debt at higher cost. Interest expense rises, deficits widen, more debt gets issued, the cycle feeds itself. If rates get pushed lower while inflation remains above those rates, the government gets relief in real terms, but savers pay the price. There is no painless option. That is one of the most important principles in understanding economics. When a system has made promises that are larger than what it can comfortably deliver, the pain does not disappear, it gets allocated. The question is not whether someone pays. The question is who pays, how they pay, and whether they understand it while it is happening. The mainstream financial discussion usually avoids saying that plainly. It prefers arguments about whether the Fed will cut by 25 basis points or 50 basis points. It prefers personality stories. It prefers political blame. It prefers dramatic headlines about secret plans. But the deeper machine is more important than the headline. The Federal Reserve is the central institution in that machine. Most people think of the Fed as a simple government agency. That is not quite the right way to understand it. The Federal Reserve System is a hybrid structure built around regional Federal Reserve banks, member banks, a board of governors, and a policy committee that sets the direction of monetary policy. It is public in some ways and bank-connected in other ways. That structure matters because money is never neutral in a debt cycle. The people closest to the creation and allocation of money usually understand the cycle before ordinary savers do. Banks, large institutions, investors, and asset owners operate with a different map of the system. They do not need to believe in slogans. They watch incentives, they watch balance sheets, they watch liquidity, they watch who benefits when policy changes. That is what ordinary investors should learn to do. Do not get trapped in the emotion of the story. Look at the incentives. If the government has too much debt and cannot easily tax cut or grow its way out, then the incentive is to reduce the real burden of that debt over time. That means inflation that is tolerated. It means rates that are managed. It means savers who earn less than they think in real terms. It means asset owners who own things that can adjust upward in nominal price. This is not a conspiracy. It is how the machine works. Machines do what they are designed to do. A debt machine protects debtors when the debtor is large enough. A monetary machine protects the system when the system is threatened, and when protecting the system requires reducing the real value of money, the people holding money bear the cost. You can dislike that, you can argue with it, you can call it unfair, but if you want to protect yourself, you have to understand it first. There is a historical precedent that is very important. After World War II, the United States had a debt to GDP ratio above 100%. Many people believed that the country had too much debt. But over the following decades, that debt burden fell dramatically relative to the size of the economy. It was not solved by simply writing a check and paying the debt down. It was solved through a combination of growth, inflation, controlled interest rates, and a financial system that encouraged or required institutions to hold government debt. In real terms, the burden of the debt was reduced as the value of money changed and the economy grew. That is the essence of financial repression. It is not dramatic enough for television, which is why most people miss it. But it is powerful enough to reshape a society. The saver who held too much low-yielding paper was quietly taxed. The borrower who owed fixed dollars benefited. The person who owned businesses, real estate, scarce assets, and productive claims on future cash flows generally had a better chance of keeping up. That is the principle. You do not need to know the exact day a policy shift happens. In fact, waiting for the exact day is usually a mistake. Big cycles do not move like light switches. They move like tides. The water rises slowly, and by the time the crowd notices, the shoreline has already changed. That is why I do not think the important question is whether one Federal Reserve chair has a secret plan to cancel the national debt. That is the wrong framing. The debt will not be canceled in a clean Obvious way it will be reduced in real terms if the system follows the path that history suggests is most likely. The number on the screen may keep rising, but what the dollars represent can be made smaller. That is how governments handle large debts when direct default is unacceptable and honest austerity is politically impossible. Now, it is also important to separate what is true from what is being exaggerated. The discussion around Kevin Warsh and the Federal Reserve contains pieces of legitimate analysis and pieces of speculation. That mixture is dangerous because when a person hears something true, they may also swallow the parts that are not proven. It is true that the Federal Reserve balance sheet matters. It is true that interest rate policy matters. It is true that the United States debt trajectory creates pressure for a different policy environment over time. It is true that financial repression has historical precedent. It is true that savers can lose purchasing power even while they feel safe. But it is not true that one person can simply walk into the Federal Reserve and command the entire system, like a king. The Federal Reserve chair is powerful, but the chair is not the whole institution. The policy process involves multiple governors, regional presidents, voting members, political constraints, market expectations, inflation data, employment data, banking system stress, and global currency dynamics. A chair can influence the path, a chair cannot repeal the cycle. It is also dangerous to treat specific rate targets as promises. If someone says rates will go to exactly this number by exactly this date, they are usually pretending that a complex adaptive system is simpler than it is. Economic systems do not operate that way. They are made of feedback loops. If rates fall too quickly and inflation accelerates, the Fed may have to respond. If rates stay too high and the banking system weakens, the Fed may have to respond. If the dollar weakens too much, policymakers may have to respond. If unemployment rises too quickly, policymakers may have to respond. The path is not fixed. The pressure is real. That is the distinction. And that distinction is what serious investors care about. They do not need a perfect forecast. They need a robust positioning plan that works across a range of probable outcomes. This is one of the most important principles I have learned. Do not build a financial life that only works if your forecast is exactly right. Build one that survives if you are early, if you are late, if the path is messy, and if the policy response changes along the way. The first thing that has to change is how you measure wealth. Most people measure wealth in nominal dollars. They ask, how much money do I have? What is my bank balance? What is my salary? What is my portfolio worth in dollars? That is incomplete. The better question is, what can my money buy today? And what will it be able to buy 5 years from now, 10 years from now, 20 years from now? If the dollar is being diluted, then a rising number can hide a falling reality. A person can feel richer while becoming poorer. This happens more often than people realize. A salary goes up, but housing rises faster. A savings account pays interest, but food, insurance, healthcare, taxes, and energy rise faster. A bond pays a coupon, but the purchasing power of that coupon declines faster. The nominal world says you are fine. The real world says you are losing. When you start measuring in purchasing power, your decisions become clearer. You stop asking whether cash feels safe. You ask whether cash protects your future consumption. You stop asking whether a bond pays interest. You ask whether the real interest rate after inflation and taxes is positive. You stop asking whether a stock is volatile. You ask whether the underlying business can raise prices, protect margins, and grow real earnings through a changing monetary environment. That is the difference between looking at money emotionally and looking at it structurally. The second thing is understanding which assets tend to work better in a repression environment. High-quality equities matter because a good business is not just a ticker symbol. A good business is a claim on future productivity. It is a system that sells something people need or strongly want, earns cash flows, adapts to costs, and in the best cases has pricing power. Pricing power is very important. If inflation raises the cost of labor, energy, materials, and capital, a weak business gets squeezed. It cannot raise prices without losing customers. Its margins fall. Its real value declines. A strong business can raise prices because its product or service is important, differentiated, or embedded in the customer's life. That business has a better chance of preserving real earnings. In an environment where money is losing value, ownership of productive businesses can be a form of protection. Not every stock will protect you. Not every company deserves to be owned. A weak equity is still weak. A speculative story is still speculative. A company with no durable cash flow can still collapse, but high-quality companies with pricing power, strong balance sheets, and durable demand are very different from cash sitting idle. Hard assets also matter. Real estate, when purchased at the right price and financed responsibly, can benefit from the fact that it is scarce, useful, and often linked to replacement costs that rise over time. Gold and silver have historically served as monetary hedges because they cannot be printed by a central bank. They do not produce cash flow, and they are volatile, but they have a role in certain environments because they sit outside the direct promise structure of paper money. The same principle applies to scarce assets more broadly. When currency is being diluted, the dollar price of things that are genuinely scarce can rise. Not always because those things became more useful, but because the measuring stick became weaker. But the asset class matters more than the marketing story. People often hear that they should diversify internationally, and sometimes that is useful. But international diversification is not a magic escape from monetary debasement. Europe has its own debt problems. Asia has its own structural pressures. Emerging markets have currency risk, political risk, and capital flow risk. The question is not simply, should I own foreign assets? The better question is, what kind of asset do I own? What cash flows does it produce? What currency is it exposed to? What balance sheet backs it? And how does it behave if inflation, policy, and growth move in different directions? That is a more serious way to think. Geography matters, but the nature of the asset matters more. The third thing is knowing the traps. The first trap is long-duration debt held without understanding the real return risk. Long-duration bonds can be very dangerous when inflation is higher than the yield you locked in. The payments may arrive exactly as promised, but the purchasing power of those payments can decline badly. That is what many bondholders learned in the inflationary periods of the past. They were paid in nominal terms, they lost in real terms. This is one of the hardest lessons for conservative savers because bonds feel responsible, they feel adult, they feel safe. But safety depends on the environment. A long-term fixed promise is not always safe when the value of money is changing. The second trap is holding large amounts of cash because the world feels uncertain. I understand why people do this. Uncertainty makes people want optionality. Cash gives optionality. Cash can be useful for emergencies, for opportunities, and for psychological stability. I am not saying cash has no role, but too much cash in a financial repression environment becomes a guaranteed tax on your future purchasing power. It is not a visible tax. It does not arrive in the mail. There is no bill from the government saying, this month we reduced the real value of your cash. It just happens. The groceries cost more. Insurance costs more. Housing costs more. Medical costs more. Services cost more. The same pile of dollars buys less life. That is the inflation tax. The third trap is concentration. People often respond to a complex environment by looking for one simple answer. They go all in on technology, or all in on gold, or all in on crypto, or all in on real estate, or all in on cash, or all in on one political prediction. That is not a strategy. That is a bet. Sometimes it works for a while, and that makes it even more dangerous because early success creates overconfidence. But in a long cycle, the environment changes. The asset that protected you in one phase can hurt you in another phase. Diversification is not about owning a little bit of everything randomly. It is about balancing exposures so that your survival does not depend on one outcome. That is a principle I believe in very strongly. You need assets that can grow. You need liquidity. You need inflation protection. You need resilience. You need the ability to be wrong and still survive. You need a structure that recognizes that no one, including me, knows the future with certainty. The people who get destroyed in debt cycles are usually not destroyed because they knew nothing. They are destroyed because they knew one thing too confidently. They believed cash was always safe. They believed bonds were always safe. They believed real estate always goes up. They believed stocks always go up. They believed gold always protects. They believed one political outcome would solve everything. The world is more complicated than that. The correct approach is to think in probabilities, not certainties. Now, let me bring this back to the national debt and the Federal Reserve, because that is the center of the system. When a country owes this much money, every policymaker faces a painful trade-off. If they defend the currency too aggressively with high rates, they put pressure on borrowers, banks, asset prices, and the government's own interest expense. If they ease too much, they risk inflation, currency weakness, and loss of confidence. That is the box. The central bank can move within the box, but it cannot pretend the box is not there. The debt is the box. That is why the debate about the next Fed chair matters, but not in the simplistic way people think. The chair can influence tone, communication, balance sheet policy, interest rate tolerance, and the speed at which repression is allowed to develop. But the chair cannot remove the fact that the debt burden creates pressure for negative real rates over time. If inflation runs at 4% and savings yields 3%, the saver loses 1% in real terms before taxes. If inflation runs at 5% and the government borrows at 3%, the real debt burden erodes. That gap is where the transfer happens. It looks technical. It is personal. It affects retirees. It affects workers. It affects business owners. It affects families trying to save for homes. It affects anyone whose assets are not positioned to keep up with the decline in money's purchasing power. This is why the person who only watches nominal returns gets confused. They say, "My savings account pays interest." They say, "My bond paid me on time." They say, "My dollars are still there." And all of that can be true while their real wealth is being drained. At the same time, the asset owner sees something different. The price of a business rises in nominal dollars. The price of real estate rises in nominal dollars. The price of scarce assets rises in nominal dollars. The owner may not be smarter. The owner may simply be positioned on the side of the system that benefits when the measuring stick shrinks. That is not morality. That is mechanics. A serious person studies mechanics. I also want to be clear about what not to do. Do not panic. Panic is almost always expensive. Panic selling, panic buying, panic moving, panic concentrating, panic. Listening to the loudest person on the internet. These are usually bad behaviors. The goal is not to be frightened. The goal is to be prepared. Preparation means looking at your assets and asking whether they are designed for the environment ahead or for the environment behind you. For many years, people were rewarded for assuming that the dollar would remain strong, inflation would remain low, the Fed would always rescue markets quickly, and the United States could borrow without meaningful constraint. Some of that may continue, some of it may not. The point is not to abandon the United States or abandon markets or hide in fear. The point is to understand that a debt cycle changes the rules of the game. When the rules change, the portfolio that worked in the last phase may not be the portfolio that survives the next phase. That is the key. I have seen this pattern across countries and across history. When the debt burden rises enough, the system becomes more political, more managed, more interventionist, and more focused on preserving itself. Savers who assume they are outside the game discover that they are actually one of the funding sources for the game. No one asks them directly. The mechanism is inflation, negative real rates, taxation, regulation, and currency debasement. That is why knowledge alone is not enough. A person can understand the problem and still do nothing. In fact, that is what most people do. They learn just enough to feel informed, then they return to the same behavior that made them vulnerable. They hold too much cash. They ignore real returns. They own assets without understanding why. They chase whatever performed best last year. They measure success in nominal dollars. They treat uncertainty as an excuse for paralysis. That is not how you navigate a cycle. You navigate a cycle by understanding the cause and effect relationships. If debt is too high, there will be pressure to reduce its real burden. If the real burden is reduced through inflation and low real rates, cash and long-duration fixed claims are vulnerable. If money is being diluted, scarce and productive assets have a better chance of holding real value. If policy is uncertain, concentration is dangerous. If the future is unknowable, resilience matters more than prediction. That is the logic chain. Once you see it, the noise becomes easier to ignore. You do not need to know the exact Fed meeting when the shift becomes obvious. You do not need to know the exact name of the person who sits in the chair. You do not need to know the exact inflation print 6 months from now. You need to know whether your financial life is built to handle the direction of the cycle. That is the serious question. If most of your wealth is sitting in cash because you are afraid, you have to ask what that fear is costing you. If most of your wealth is in long-duration bonds because you think nominal stability equals safety, you have to ask what happens if inflation stays above the yield. If most of your wealth is in one asset class because it has worked recently, you have to ask what happens when the environment changes. If you own businesses or funds, you have to ask whether the underlying companies have pricing power, strong balance sheets, and real demand. If you own real estate, you have to ask whether the financing is sustainable, whether the cash flow is real, and whether the price already assumes too much. If you own gold or other hard assets, you have to ask what role they play and how much is enough without becoming overconcentrated. This is not about finding a perfect answer. There is no perfect answer. There is only a thoughtful structure. The world does not reward certainty. It rewards preparation, adaptability, and the ability to survive long enough for compounding to work. The coming decade may reward people who understand the difference between money and wealth. Money is the claim. Wealth is the thing the claim can buy. Money can be printed. Real wealth cannot be printed in the same way. A productive business cannot be printed by a central bank. A scarce property in a useful location cannot be printed by a central bank. An ounce of gold cannot be printed by a central bank. A skill, a network, a durable income stream, a resilient portfolio, these are not created by pushing a button at a monetary authority. That is why, in debt cycles, the ownership of real and productive things becomes so important. But ownership must be intelligent. Buying a bad asset at a bad price is not protection. It is speculation. Buying a story because it sounds dramatic is not protection. It is emotion. Buying anything because someone on social media says the Fed is about to do something on a certain date is not a plan. It is reaction. The plan is to understand the pressure, understand the mechanism, and position gradually and systematically. That is how you avoid being shaken out by volatility or seduced by hype. The system is not going to stop because you need more time. The debt compounds, interest accrues, policy adjusts, inflation moves through the economy. Asset prices respond, the machine keeps running. You can either understand the machine or be processed by it. That may sound harsh, but it is better to confront reality than to be comforted by illusion. The person who waits for certainty will usually act too late. By the time everyone agrees that financial repression is happening, the assets that benefit may already have repriced. By the time everyone agrees that cash was dangerous, the purchasing power may already be gone. By the time everyone agrees that the debt problem matters, the cycle may already have done its work. Cycles do not wait for consensus. That is why the right approach is not to make one dramatic move. It is to build a durable structure before the crowd fully understands why it was needed. Measure wealth in purchasing power, own productive assets with pricing power. Maintain exposure to scarce assets that cannot be printed. Avoid being trapped in long-duration claims that pay you back in weakened money. Hold enough liquidity for resilience, but do not mistake idle cash for long-term safety. Diversify across asset classes so that you are not dependent on one version of the future. And above all, think in cause and effect. That is the difference between being a victim of the cycle and being a student of it. The debt is not just a number. The Fed is not just a headline. Inflation is not just a statistic. Interest rates are not just policy settings. They are parts of one connected system. When one part moves, the others respond. If you understand the system, you can make better decisions. If you do not, you will keep reacting emotionally to symptoms while missing the cause. This is the point I want to leave you with. There is no secret button that cancels $39 trillion of debt without consequences. There is no painless reset. There is no magic chair at the Federal Reserve who can make the arithmetic disappear. There is only a set of choices, and every choice allocates pain. If the pain is allocated through inflation and negative real rates, savers pay. If it is allocated through austerity, voters pay. If it is allocated through taxes, earners and asset owners pay. If it is allocated through direct default, creditors pay. The most politically tolerable path is often the quiet one. That is why financial repression is so powerful. People rarely revolt against what they do not clearly see. They just notice years later that life got more expensive. Savings bought less, retirement required more, and the people who owned the right assets moved further ahead. Do not wait until that lesson becomes obvious. The information is already enough to act thoughtfully, not recklessly, not emotionally, not all at once, but deliberately. Because the question is not whether the system is fair, the question is whether you understand it well enough to protect yourself inside it. That is what serious investing is. It is not predicting headlines. It is understanding machines. And this machine is telling you something clearly. The debt cannot keep growing forever without changing the value of money, the behavior of the Fed, the return on cash, the risk of bonds, and the reward for owning productive and scarce assets. You can ignore that because it is uncomfortable, or you can study it, respect it, and position yourself with discipline. History does not reward the people who complain about cycles. It rewards the people who understand them early enough to adapt.